Welcome to the Daily Update, where I'll go over the action in the market for Monday, July 3rd, and then we'll see how things look for Wednesday, July 5th. The market will be closed in observance of the July 4th holiday. So I want to wish a happy Independence Day to everybody. I know this is an American holiday, but if you are in America, I hope you have a nice barbecue, maybe watch some fireworks, and enjoy the idea behind American independence. As far as the market is concerned, it was a shortened day. The market closed early. Volume was well below average, but we had a slight upward bias as we went into the close. Let's go back and talk about what happened. We had a flat to slightly lower open right off the bat, but prices were able to stay above the daily pivot at 44.44. As the day went on, we drifted back above the unchanged level and moved slightly higher going into the close, and that was pretty much it for the day. We were up 0.12% on below average volume because of the shortened day and because it's before a holiday. A lot of people decided to take a 4-day weekend. The technicals are positive overall, but we're looking overbought in the short term and somewhat in the intermediate term, but things are showing some improvement, and I'll show you some charts to back that up. Inflation and interest rates are still the main focus. Growth concerns seem to be leaning a little bit more towards the positive side right now, that maybe we'll be able to avoid a recession and experience a soft landing. We're still keeping an eye on what's happening in Russia and in neighboring countries to see if that escalates in any way. What are some comments that we can make? It was the first trading day of the week, month, and quarter, so now you're going to see lots of charts and lots of people talking about, here's the first half of 2023, how does the second half look? And I have some charts to show you as well. Bank stocks had a pretty good day on Monday, but they still have a long ways to go to pick up some lost ground. There's still that growing optimism that the U.S. economy could avoid a recession. Now, if we get a few economic reports that come out stronger than expected, it's going to blow that scenario out of the water. But that's where the market seems to be standing right now. On a short-term basis, we have the 20-period exponential moving average, the Williams percent R, the CCI 14 and 20, the stochastics, the standard deviations chart, our Rune indicator, the McClellan oscillator based on the S&P, the PMO study, the RSI based on 9 periods, and the boom indicator based on 20 periods. This list is the same as for the video that I made for Monday. On an intermediate term basis, our oscillators are turning back a little more positive, but we're still kind of at extreme levels when you look back to where we were at before. The Sean trend meter, and we're also keeping an eye on the rate of change going back 200 periods, more on an intermediate term basis. The dollar was up and interest rates were also up. All of the yield curves that we've been following remain inverted. Sentiment ticked up. We're at 85 now, where we had been at 79. That's extreme positive, and we're getting to the point now where the market's a little over-exuberant. Our trend is still positive, but even with the up day, the green line came down a little bit on the ADX, but the ADX is crossed back above its moving average, and both of them are above 20. Our bias is positive, and our momentum is positive. The economic reports that came out, we had the ISM Manufacturing Index. This was probably the most important one. It came in at 46, which is lower than the 47.1 they had expected. Last time it came out at 46.9. The takeaway from this is it's below 50. Above 50 means expansion. Below 50 means contraction. We also had total construction spending. It came in up 0.9% on a month-over-month basis, more than the 0.4% they had expected. Last time it came in at 0.4%. Year over year, that equates to 2.4%. Total private construction was up 1.1% month over month, and total public construction was up 0.1% month over month. Here's a look at some of the charts. Here is construction spending, where it had been coming down, but now it's starting to go back up. Here's private construction spending. Residential continues to decline, where non-residential is continuing to advance. Then on a month-over-month basis, we did see an increase in construction spending. Looking at the ISM index, and this is a pretty important report, the blue line continues to decline, and the orders are starting to bounce back up, but they have been in an overall decline. Looking at the prices and deliveries, we're seeing a decline with prices, and we're seeing deliveries turning back up slightly. And then the trade also is showing that imports are increasing a little bit while exports are decreasing slightly. And then looking at the index overall, it did tick down a little bit, so it is showing some weakness, but it's not necessarily falling apart. Looking at some Isabel Net blog charts, this says a strong start to a year could mean more gains. When we have a good first half of the year, what happened after that? Going back from 1950 to now, we're looking at anywhere from a 12 to 17% return going forward. Doesn't mean that's going to happen. That just has been what historically has happened. Then we look at the Fed Fund futures curve where it has actually increased a little bit. The purple line is what they thought it would be a week ago. The blue line is what they think it will be now. Then we're looking at earnings per share. Goldman Sachs is still pretty optimistic. They're expecting earnings to increase. They're also looking at the S&P 500 going up to 4,500 in 2023. This is another chart that we look at from time to time, which is showing some increase in economic activity. This is heavy truck sales, and they are starting to go up. And then we look at all these different things that are happening, and these are what are people getting into or getting out of. The big one on the top is Japan, followed by REITs, which is real estate. And then at the bottom, people are getting out of tips. Now, these are inflation-adjusted shorter-term bonds that every time you renew it, it renews at the current interest rate. And if interest rates are going up, you want to own tips because you'll roll into a higher interest rate. If interest rates stay the same or go down, then it's better to get into other investments. And so we're seeing a lot of outflows in those investments right now. Also, not a lot of bank loans going on currently. Are you more likely to increase or decrease bond portfolio duration over the coming weeks? People are looking further out now, that they're expecting longer-term rates to come back up higher. They're willing to lock in a higher interest rate, or at least that's what they think will happen. The sentiment indicator that we look at is also extreme positive, which confirms the other indicators that we follow. Then seasonality for the NASDAQ 100. Here we are right in the middle where we had a good first half to the year. So historically, this is what's happened in the second half of the year when you measure the period from 1985 up to 2022. Getting into our charts and analysis, here's the intraday chart. Really not much happened. We had a slightly lower open. We came down to the daily pivot, then quickly bounced up off of that, and then just drifted along the unchanged level with a slight upward bias going into the close, and we did close a number of hours early. Here's the intraday chart where we were flat before the market opened, and then we turned a little bit more positive before the market opened, only to see that come down as the cash market opened, and then we drifted higher going into the close. Value is now outperforming growth, and it actually had a better day where growth was up 0.07, value was up 0.28 for the large caps. Growth also underperformed with the mid caps and with the small caps. Then looking at the growth to value ratio where it was negative and then started to claw its way back near the end of the day. Looking at sentiment, our Ulcer Index is flattening out, but still suggesting there's not a lot of fear. The VIX actually went up a little bit, but was pretty much flat on the line chart as well as the bar chart. The VIX of the VIX shows that volatility is picking up just a little bit from Friday, but it's still very low. We're keeping an eye on this other chart because the correlation between the VIX and the S&P, it's starting to go up. We're not at this dashed line yet, but we want to keep an eye on this chart. The equity put call ratio continues to dip slightly because we had a slight up day. And the equity put call ratio going back 253 periods with a simple moving average continues to decline. That's longer term positive. The skew index is starting to come up a little bit. We're not quite into this red area yet, but if this does go up, that means the market is anticipating some kind of a move. Whether it's to the upside or downside, we don't know. Other times when we had an extreme reading, it could mark either one. The MOVE index ticked down just slightly on Monday, where the VIX was pretty much flat to slightly declining, and we're seeing the correlation really going in opposite directions currently. This other fear gauge that we follow is also showing a decrease in fear, as well as the other fear gauge that we follow, and folks are still favoring a risk-on position. Looking at the advanced decline line studies, we did see some improvement based on price and volume. And the new highs were up more than the new lows, but because the day was shorter, we didn't see a real high reading here. Our 5 period is pretty much going sideways, where our 10 period is actually turned down slightly. Ratio is above 0 and advancing. That's positive. Accumulation distribution continues to be positive. We're seeing improvement with the cumulative advanced decline line for the NYSE, and the regular advanced decline line is also showing some improvement. We're also still above this trend line with the other advanced decline line for the NYSE. When we look at common stock, we're seeing some improvement based on price and a little bit of improvement based on volume. Looking at our other advanced decline line studies, the NYSE is showing improvement, as is the S&P, the mid caps, and the small caps. All of them are above their moving averages. Looking at the trend, where the green line ticked down just slightly, but the ADX is going back above the moving average. So we would default to the positive side, but be a little bit aware of this green line coming down. On a shorter term basis, we also saw the green line coming down, but the ADX is turning and starting to go back up. Volume really dropped off because of the holiday shortened trading session. On a short-term basis, we're still above this previous high, and we're looking okay on this chart. I extended this trend line up. In case we do continue to go up, this might provide some kind of overhead resistance. And then on the bottom, you see where volume was well below average. We're still extreme positive with the 20-period moving average. We're showing improvement with the 50 and the 200. The boom indicator is still looking extreme positive on the 20 period. We're showing improvement with the 50 as well as the 200. Williams percent R still remains extreme positive. Now we can take this two ways, that we're extended to the upside and due for a pullback, or if this camps up in this upper area for a while, that can also suggest good momentum. The CCI 14, and we can make those two assumptions as well. With the 14 period and the 20 period, they are both extreme positive. The short-term stochastics starting to get extreme. Intermediate term going back extreme and turning back up extreme in the long term. The force index declined just a little bit but continues to be positive. Some of our intermediate term charts, we turned down a little bit with the balance of power, but we're still above the dashed line. The go-no-go system remains positive with the darker colored blue bars. We're up at the upper end of the highest high right now, which suggests positive momentum. The TTM squeeze is actually showing a little bit of improvement. We started to go back up slightly, and we have a lighter shade of blue for the bar. We're still in the third standard deviation on this chart, suggesting that we may have gone up too far too fast. The PPO studies remain positive across the board, even though it ticked down slightly in the short term. The S&P McClellan oscillator also looking extreme positive. Now it could still go higher, but we just start to watch it when it gets above the 60 level. The summation index based on price is now looking more positive, and we're turning back up based on volume. The NYSE McClellan oscillator is above zero and advancing, so that's positive, and we're showing some improvement with the NYSE summation index based on price and volume. The Erin indicator, after giving us an extreme positive reading, ticked down slightly. Again, this could stay up here for a while if we're showing good momentum, or it could signal an overbought condition. The Swenlin trading oscillator, based on price and volume, continued to advance and are positive. The Elder impulse system for the S&P remains positive. The dots are underneath with the parabolic SAR. That's positive. The PMO starting to turn back up. We've turned up based on price, and we're starting to cross back over positive based on volume. Our PMO study still suggests that we're extreme positive with the PMOs that are rising. The buy signals are improving and just below the extreme reading, and we're also seeing this turn back up with the PMOs that are above zero. The slope, which is usually our touchiest oscillator, it's turning a little bit, but it hasn't crossed over positive yet, where the MACD is turned back and is looking more positive. So when we look at all of our oscillators, the slope is not really behaving right now based on price, but the MACD is. The TSI's turned back up. We're going back up with the PMO. We're showing improvement with the PPO. The TRIX is actually going down a little bit, as is the KST. The bullish percent index is still showing improvement and is not giving us an extreme reading currently. The Sean trend meter, though, is starting to get to an extreme positive reading. The NYSE bullish percent index is above 50 and advancing and showing improvement. The Chaikin oscillator is above zero and advancing. The ultimate oscillator ticked down slightly but is still above 50. The vortex turned up just a little bit with the green line, but the red line also turned up slightly, but this is still positive. The money flow ticked down just a little bit, but also is above 50. The Chaikin money flow continues to be positive. The The RSI in 14 periods were just below this extreme positive reading, where the 9 period has now gone extreme positive. On balance volume is still positive and we're above an advancing moving average. Looking back 200 periods with the rate of change, we're starting to break out above what could be more intermediate term overhead resistance. Then looking at the stocks above their 200-day moving average, that is showing some improvement, and we're seeing even a little more improvement with the stocks above their 50-period moving average. And here's another look at that same chart. Our Fibonacci and line studies, we're still coming up to what could be resistance above current price. We're still above the 100% retracement level with the S&P. We're far away from this now, but if we really start to fall, we'll see if this offers some kind of support. We're also seeing that same thing with the longer-term fib chart. We're still above the 61.8% retracement level. And then longer term, we're above this other retracement level. The next level up for this chart would be to test the all-time high. Our different charts looking more positive. The Heiken Ashi is looking good. The Kegi chart is positive, the Renko chart is positive, and the 3-line break is positive. Our different indexes, we saw a little bit of improvement with the equal weight index, but it's still underperforming the S&P. Then looking at new Dow theory, I brought this up over the weekend where we were breaking out with the S&P 500. Well, now we're just barely breaking out with the NASDAQ. This was seen as a little bit of a negative divergence, but for right now anyway, it looks to be improving. The transports continue to show a lot of strength, and they're going back up and testing this previous high. Will we be able to break through that, or is this going to provide overhead resistance? The transports doing well really helps the S&P 500. The utilities also showed some improvement, but have not been able to exceed this downward sloping trend line. Here's the ratio between the transports and the S&P, where it ticked up just slightly, but they have been rising overall. We want this ratio to continue to go up to give good solid support to the S&P. And we're seeing the correlation between the S&P and the transports continue to get stronger. And the transports are just about even now with the Dow. The equal weight index ticked down just slightly in this ratio, but overall, as this ratio declines, that means that there's more broad participation by other stocks than just the real big ones. Looking at the discretionary equal weight, we were up slightly. Staples were also up slightly. But Staples outperformed discretionary, so we turned down a little bit with the ratio, but still, discretionary has been outperforming Staples. The Dow was pretty much flat on the day, but we still remain positive with the Elder's Impulse system. The NASDAQ is still underneath this resistance level, and we're also still below the 61.8% retracement level, which is just about the same place as the resistance level on the previous chart. The cumulative new highs, new lows for the NASDAQ continue to show some weakness, even though we were able to climb above zero. This is another issue we're keeping an eye on. We're going back and testing a previous high with the NASDAQ 100. We have not been able to break through that yet. Is this going to provide overhead resistance where we fall back, or will we be able to break through that? The Elder Impulse system for the Qs remains positive, and we're still above the 61.8% retracement level for the NASDAQ 100. The NASDAQ BPI continues to show some improvement. A week ago, David Keller from StockCharts.com thought this was a major signal. I didn't think it was that big of a deal at the time, although we did note it, but now we're seeing some improvement here, so maybe that signal will be negated. Small caps were up 0.62%, and we're still kind of at the higher range of this resistance area. Notice the moving averages here. We're far away from the 50 to 200 period moving average, but when we look at the Russell 2000 index, we're getting ready to see a golden cross here. We're also seeing the RSI above 50 and advancing, and the MACD starting to turn up. The Elder Impulse system for the small caps remains positive. And we saw a little bit of a decline in the growth to value ratio for the small caps, but they are still in an overall uptrend. And the small caps did outperform the bigger stocks on Monday, but still they remain in a downtrend, so they are underperforming overall. The mid caps still remain positive for the Elder Impulse system. The mid caps are also showing a little bit more strength. They were up 0.31% after recently generating a golden cross. And mid-cap growth versus value did decline a little bit, but is still seeing overall strength. On a broad measure, we look at the S&P 1500 and compare it to shorter-term bonds where stocks are really outperforming. Another broad market measure also shows that stocks are outperforming when we compare it to 3 to 7 year bonds. The tech sector continues to outperform bonds. And the S&P is also continuing to outperform bonds, suggesting that we may see a soft landing. Keeping an eye on banks, the financial sector was up 0.87% and was able to get back above its 200-day moving average. The financials still have a long way to go and are still really underperforming the S&P 500. When we look at the regional banks and compare it to the financial sector, we did see a decline and we're seeing overall weakness. Keeping an eye on bonds, we were up based on yield and down based on price, and we've actually broke below the 200-day moving average. The RSI is turning more negative, and the MACD is starting to cross over negative as well. If bonds continue to fall, that means interest rates will continue to go up. Keeping an eye on the value to growth ratio and its relationship to the 10-year yield, where we're seeing that relationship start to weaken now. They're going more in opposite directions. But folks are still tending to prefer riskier bonds over more conservative bonds to get a higher yield. Looking at cash and comparing it to the 3 to 7 year bond ETF, we're still seeing this rise in the overall ratio, and we might see a golden cross here with this ratio. We wanted to see this ratio going down. Instead, it's turning and going back up. And we're still above the 2007 level on the 3-month yield. If that drops back down, will that be giving us some kind of a warning sign? Our long-term analysis still shows on the daily chart the special K is looking more positive, or on a weekly chart, it's still looking more negative. Update of our possible positive scenarios. We're advancing based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio for the S&P. The Qs slightly outperformed the S&P on Monday, so we saw a little bit of an improvement. Discretionary is showing some strength compared to the S&P. Large cap growth to large cap value is coming back down to the moving average. Our other growth to value ratios still hanging in there with the large caps, turning down a bit with the mid caps, and still showing some weakness with the small caps. Looking at the S&P stocks above their 50-period moving average, this continues to show improvement. We're also seeing some improvement with the mid caps as well as the small caps. The percent of stocks in the S&P above their 200-day moving average also continues to improve. And the S&P to utilities ratio continues to go up, which often gives good support to the S&P. We're also still pretty high when we look at the 10-day average of the S&P highs minus the lows. The longer we stay up here, the longer it suggests that it's not an overbought condition. It could be good momentum to the upside. When we look at the broad range of the moving average of highs minus the lows taken over 5 periods, we are above zero after crossing back below zero last week. The 50-period exponential moving average of the new highs minus the new lows continue to show improvement, and our indicator, even though it ticked down a little bit, is still above zero. But this is another little bit of a concern. The growth to value ratio for the S&P is continuing to go down, even though it's still in an overall uptrend. The Staples to S&P 500 ratio did tick up slightly, but we're still declining overall. So what's our outlook for Wednesday? Please be aware that the market is closed on July 4th. The technicals are still positive, showing some improvement. We could make a case to say that on a short-term basis we're overbought, and even on an intermediate-term basis we're looking a little toppy right now. The economic reports that will be coming out will get the MBA Mortgage Applications Index, the AD employment change, factory orders. And then the meeting minutes will be coming out from the last FOMC meeting. Geopolitical events, keeping an eye on Russia, which now also includes Belarus, to see if that escalates at all and then has an impact on the stock market. Inflation and interest rates are what the market is really concerned about right now. Here's the updated economic calendar for the week. And then looking at the Stock Traders Almanac statistics for July 5th, we're kind of negative overall. The Dow is only up 38.1% of the time, where we're more neutral to negative with the S&P and the NASDAQ. We will be on the second trading day of the month, where we do see some initial strength in the initial part of July. Then we start to chop more or less sideways. It's about the middle of the month where we start to see more weakness. We're also seeing that same thing when we look at the NASDAQ, which tends to do well going into the middle part of July. So our scenarios, we can't really go with the down one right now because our technicals are positive, they're improving, even though we are short-term overbought and somewhat intermediate-term overbought. So we're still defaulting to the up scenario. Be aware of that green line on the ADX. It has dropped. If you go into a long position, my philosophy is only get in if the market is actually up. We're not really going with the sideways trend right now because both of our ADX charts are suggesting that we are in a strong trend. So our warning signs, the VIX is still showing that there's not a lot of fear. It also may be starting to act weird. That's why we're pulling out that other chart of the ratio between the S&P and the VIX to keep an eye on that. The cumulative new highs and new lows still are showing weakness in the NASDAQ. The 3-month yield is still above the 2007 levels, which happened right before the great financial crisis. Earnings season can be either positive or negative. On the positive side, the parabolic SAR has now spent 2 days with the dots underneath, so it is now turned back positive. Our longer-term seasonality and setup still remain. I don't cover those charts in this video, but I did cover them in the weekly video that I posted over the weekend. The long-term special K on the daily chart is positive, where the weekly chart is negative. Our long-term equity put-call ratio is still looking more positive. We're still above that downtrend channel upper line. I haven't been showing that chart because we're far away from that line. We're still in a risk-on posture. The transports are improving and are now looking like they could be breaking out. Lower price levels so far have been holding if we have been pulling back. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100 continue to break out, but have significant overhead resistance. The NASDAQ is at that 61.8% fib retracement level, and the NASDAQ 100 is at that previous high. The staples to S&P 500 ratio is declining, which is positive for the S&P. The mid-caps generated a recent golden cross, and we might be seeing a new one soon with the small caps based on the Russell 2000 index. But small and mid-cap growth, even though it didn't do that great on Monday, is still positive overall. So our conclusion, the S&P it's positive, showing improvement, but we're also pretty toppy right now. We could make a case that we are overbought. Short term we're positive, but considered to be overbought. In the intermediate term we are positive, showing some improvement, but we are also showing some overbought conditions. Long term we continue to be positive. Thank you. I want to wish everybody again a very happy Independence Day. Have a great celebration, and I will talk to you in the next video.